Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
I'm Jeff Benjamin, Wealth Management Editor here at ETF.com.
This week, we're talking with Gibb, Head of Commodities Index Products at Bloomberg. Gibb, great to have you with us.
Gibb, tell us a little bit about yourself. What do you do at Bloomberg?
Hi there. So my name's Gibb. I'm responsible for our commodities and crypto index products at Bloomberg. I joined 6 months ago, and we've really been working at building out and expanding the index suite from the BCom to new indices, evolving our presence in the crypto space as well.
That's great. So, Jigna, I've been looking at the commodity headlines recently, and the one thing that stands out, of course, is people talking about OPEC making their decision and how they might be raising supply later this year. What kind of trends are you seeing in the commodity markets today?
Yeah, so it's true. Commodities are back. That's generally a theme that we've been seeing, particularly after 2022, where we had that period of market turmoil. Bonds, equities both failed to perform. Inflation was at elevated levels. Traditional correlations decoupled. And in that episode, commodities was one of the few asset classes to really perform strongly. And we're seeing that trend continue to evolve over 2024. So in terms of what have been key themes and what's been playing out for the asset class, at the beginning of the year, we outlined 6 key themes that would be impacting commodities for 2024. Those were the economic conditions in China and the shift of China to India, and India being the emergence of India as a role as a very heavy importer of commodities. The second theme that we've seen playing out is the geopolitical aspect and the conflicts that have been bubbling along as we've seen over the last couple of years, but then also erupt over the course of this year as well. We've also seen energy transition gain traction and continue to be a key theme and topic on the agenda for many of our clients this year. And then the other 3 factors that we see are along the lines of adverse weather conditions, the path of inflation, which again has been somewhat uncertain and sticky, and we've seen the various central banks use rhetoric around higher for longer, which is potentially a response to where we are in inflation, and that has ramifications for commodity prices. And then the final factor is what's happening in the shapes of the forward curve and the fact that we've got the term structures on the commodity futures curves. So overall, of those 6 factors, we've definitely seen a good number playing out this year and driving commodity prices higher. And then at the micro level, you do see OPEC responding to the on the supply side as well, and that's all then contributing to where we're seeing price levels coming into play. One thing that I will note that is interesting is even though we are seeing higher price levels, volatility has been relatively subdued. So if we're to measure the volatility of WTI and Brent, they've actually hit multi-year lows over the course of Q2. So while commodity prices are high, generally, volatilities have really come off over the course of 2024. That means that commodity prices have somewhat been in a range, so they've been hovering around certain levels for the energies in particular.
Commodities, they've always fascinated me as a category, as an investment category. What's the role of commodities index products in a diversified portfolio? Is this a volatility dampening strategy? What kind of a hedge is it? And should it be there all the time?
That's a really good question, Jeff, because when it comes to commodities, I think the D word comes up a lot, and that D word is diversification. We actually published a paper just a month or so ago, which talks about the power of a commodity allocation in your traditional 60-40 portfolio. And the tagline is, a little goes a long way. So what do we mean by that? Well, when you think about the role of commodities in a traditional asset portfolio, they generally fulfill 2 objectives. One is to be a portfolio diversifier, and the second objective is to help with inflation hedging. So when we think of the characteristics in respect of a portfolio diversification perspective, what we think of is taking our traditional 60-40 bond equity portfolio and adding commodities into the mix. And when we do that with our berry strategy, what we find is that we boost the Sharpe ratio whilst also dampening the drawdowns and the Kalmar ratio. And in fact, the ideal range that we see for an allocation to commodities to act as a portfolio diversifier in the portfolio is somewhere between 4 to 9%. Now, on the other side, thinking about commodities as an inflation hedge, we've done analysis to think about how commodities can effectively hedge, looking again at our Bloomberg Enhanced Roll Yield strategy, BERRY, against our US CPI numbers and 10-year break-evens. And when we've run the analysis and rolled correlations, what we can find an effective beta for commodities against the 10-year US break-evens is something around 15. And so coming to sizing that in your portfolio, somewhere of 1/15, which represents around 7% of your allocation, would be a meaningful inflation hedge. So those are the two primary objectives of why many asset allocators think of commodities and the role of commodities in their portfolio as a broad-based investment, and then how we go about sizing them. Now, that's also sits very much alongside commodities being exposed through sectors and singles, which can be somewhat tactical. And in fact, I'm currently working on a regime-based analysis that will look at the 4 different quadrants of inflation versus growth, and will select, depending on your outlook across the different economic cycles, different sectors of commodities will play out. So in a more defensive outlook, one might want to go over long the precious metals. In more of a booming scenario, the energy and industrial metal sectors will benefit.
So Jigna, you obviously deal with commodity indexes. Obviously, we look at ETFs all the time and commodity ETFs as well, and we see a mix of commodity index based products as well as more active products. Do you have an opinion on, which one is better in terms of, portfolio diversification and returns and things like that?
Yeah, so I will wear a hat of being an index, being an index provider, that we provide a good suite of solutions on the index side. But yes, there are a range of products available out there. What I will say is that there has been an enormous amount of evolution when it has come to the index space, and I think commodities has been one of the leading asset classes when it comes to active versus passive, and the passive index really driving forward with respect of innovation. And I say that because I lean back on my 21 years of experience in commodity markets and look back to when we started, really thinking about commodities. One would think about accessing through CTAs or active managers or through some active format. Since then, systematic investors using an index which enables a transparent, systematic or access, and usually a lower cost access to the markets, has really taken off and has really been the investment format of choice for both institutional and retail investors across the board. And of course, the ETNs and ETFs and ETPs more broadly have really expanded the access to a wide range of these indices. So it's gone hand in hand in terms of the innovation that we've offered on the index side, but the packaging of the indices through these ETP products has really enabled access to a range of investors.
You mentioned innovation on the index side. Can you talk about some of that innovation? And also, I can't help thinking about commodities without thinking about geopolitics. It's obviously, it's got to be a big factor. What's the impact there? And I know you talked a little bit about that, but if you could elaborate.
Yeah, let me talk about the innovation first, and I'll revisit the geopolitics point later. So in terms of innovation, we at Bloomberg are heavily spending a lot of our efforts and time in thinking about solving the problems for tomorrow and being part of our clients' solutions. So when it comes to innovation, we're generally seeing a lot of drive towards thinking about enhancing our long only broad-based indices, and we've got a proposal of doing that in our roll yield enhanced index families, of which, as I mentioned previously, Berry, which is one of our indices, sits. We've also been exploring the concept of expanding the universe, so enabling access to a wider universe of commodities when we define and create a benchmark. So within an expanded universe, we're looking at creating a BCom XL strategy, which would then encompass a wider scope of components. That would then enable us to look at a wider range of underliers, grow and access pools of liquidity, but also increase capacity in many ways of accessing commodity markets. So those are two ways that we're thinking of innovation, and we're seeing the market appetite really picking up in that respect. I'll talk about geopolitics, and you're right in that the geopolitics is a big fundamental driver of what has been contributing to both price but also heightened volatility. So global tensions have been on the surface and have been bubbling along. You don't have to look too far back. It was really back in February 2022 that we saw with the invasion of Iraq that oil prices reacted quite aggressively to that news. And so commodity prices tend to move rapidly at the start of a conflict. And that tends to be when the idiosyncratic events cause market participants to position themselves quite rapidly. And that's based on how they might perceive market events to disrupt the supply and the demand factors. So we see that playing out over the most recent history, and that continues to be a way that we see the impact on the spot prices. If I look more specifically, more recently, as of the end of 2023, we saw the uncertain situation in the Middle East and the Gaza conflict spilling into attacks and ships in the Red Sea. That disrupted aspects like shipping routes and then also further boosted crude oil prices. So these conflicts tend to shake up the commodity markets. And if we continue to see further escalation, they can cause further volatility and swings as both supply chains are hit, but also we have an impact in terms of the production cycle. So generally in these situations of rising tensions, we see aspects like precious metals tend to benefit in the short term. And then we also see on the flip side, we also see that oil has heightened volatility in the more sensitive areas where the production aspect might be impacted.
So, Jigna, obviously we've talked a lot about commodities, but you focus on blockchain and crypto and things like that as well. Can you talk a little bit about that? What's been the evolution of crypto index products so far? And maybe you can talk about, what's to come in the future.
Yeah, this has definitely been a very hot topic for this year and continues to be one that gets discussed at various events, conferences that we attend. And one thing that I'll start off by saying is where crypto started off very much being a conversation or a product for the retail segment of the market, we're now seeing the expansion of institutional investors looking much more closely at the asset class and looking at crypto a lot more closely. So in respect of crypto, we've seen an expansion more broadly of the tokens that have been launched since Bitcoin emerged back in 2009. And one of the things that we see is that if you look at the ETF products, that since the start of the year and the SEC approving the registering the first crypto ETF, there really was sort of opening of that door, if you will, into the gateway of this very early stage asset class and enabling the institutional community to access that crypto market. So as of the end of April, there was actually 88 billion of assets under management across 225 crypto ETFs listed globally. And 182 of those were passive. And that's something that you can source on the Bloomberg ETF function. And so there has been an enormous amount of interest in the asset class. And alongside that, there's been a reflection of asset growth as well. From an index perspective, at Bloomberg, we've launched this year 2 indices, one referencing the Bitcoin and the second on Ethereum. And these are our single indices. Alongside that, we do have baskets. One is an equal weighted basket, and the second is a market cap basket. So there are different ways of how one can access crypto as an asset class, but we're definitely seeing the emergence of the ETF as a good gateway, if you will, to the institutional community as well as the retail segment to enable access to crypto markets.
If I'm a financial advisor, how do I filter through all this to know which products are best for my clients? I mean, this is not a one size fits all category, clearly, right?
Yeah. Yeah, and Jeff, that's a really good question. And I think the best way of addressing that is to understand the investment objective of your clients. What is it that they're aiming to achieve from the allocation to crypto?
Mm-hmm.
And I think that's important because understanding the reason why will enable the answer to how. And whilst we don't outline and we leave that to the audience to determine as to why they would invest, there are many reasons why one might invest in crypto assets. So rationales for doing that include it's a frontier market, and so it could be a new and emerging marketplace. So that's something that one might want to think about in the portfolio capacity. It's a digital payment asset, and so the fact that this is a payment method via an online system. There's also the aspect of very much driven by momentum and sentiment driven characteristics of the crypto market. And this is a compounding feature from the network effects. As such, the value increases as more users and developers join the community. And therefore, one can think of it as a trading opportunity with momentum. One can also think of it as a diversifier. I've seen that crypto has had quite a neutral correlations against both bonds and equities, looking back historically. So from a traditional asset allocation perspective, there is an argument to make that it could act as a diversifier in a traditional portfolio. And then the last rationale as to why one might think about crypto in a portfolio is considering it as a US dollar alternative. Now, we don't have to look too far back in history to remember when there were concerns over the US debt ceiling. In fact, it was only 2 years ago. And there was a lot of debate as to what was going to happen in the extension of the debt ceiling. That all washed through. But at the time, questions were asked as what is a viable alternative to the US dollar in this period of stress? And that is when a lot of the dialogue, particularly with some of the institutional investors, was coming up to, do we consider crypto in this environment or this situation? So those are reasons as to why one might think of investing in crypto. In a recent blog that we published, we apply an institutional framework in terms of how to size crypto in your portfolio. And I have an answer for that. One of the things that we consider in terms of crypto in a multi-asset portfolio is to say that it is and has been quite a volatile asset class. In fact, if you look at the historical 1-year volatility, over the long run, one would say it's about 100%, but that's a declining volatility profile. So the current measure is somewhere around 48%. So it's volatile compared to equities, bonds, and even commodities. And so thinking about how to size crypto in your traditional asset portfolio goes along the lines of how you measure your risk. So we apply a risk framework in terms of thinking about how much to allocate to crypto. And in that risk framework, what we apply is looking at the traditional asset portfolio, seeing when we have experienced those max drawdowns and measured if crypto was 1%, 2%, up to 5% of my portfolio. And at the time of stress, crypto had also devalued and gone down to zero. How much additional loss am I willing to tolerate? So we introduced this concept of a max loss tolerance to stress and devalue your allocation to crypto to determine the appropriate sizing. And what we find in our results is with a 99% multi-asset portfolio that then allocates 1% to crypto, the additional loss that one could tolerate is something like 2.6% in a max drawdown scenario. So our conclusion is that a small crypto allocation can provide additional source of returns to traditional assets. However, when it comes to deciding how much to invest, understand your loss tolerance.
Great stuff. So, Jigna, I want to turn back to commodities now. A big topic in terms of commodity ETFs is this concept of contango and backwardation.
Mm-hmm.
Obviously, a lot of investors who bought commodities ETFs early on, they've felt a lot of pressure on their returns from the roll cost associated with contango. What do you think about that? How are crypto indexes being, or sorry, not crypto indexes, commodity indexes being designed today to kind of mitigate that negative effect of contango?
Jeff, that's an excellent question because it really does outline the history of where we've seen the evolution of product. And I'm really glad that we can talk about not just spot prices, but the other facets of a commodity investment. So if I can take a step back and think, why does one invest in commodities? We talked about diversification and inflation. How does one get that return? Well, there are three traditional ways of thinking of returns in commodities, and those are the spot price, which we've covered, the roll yield, which is the premise of what we're addressing here, and the third aspect is a carry function or an additional carry return. So spot price returns are very much aligned to what one was thinking of in terms of a front month investment, and that's what the BCOM in the front month index is generating. However, with the shape of the forward curves being upward sloping, and we call that contango, that means that in terms of to maintain your investment in commodities, there is a negative roll cost, i.e. there's a drag on the performance. One can think about how to mitigate that by doing what we call an enhanced investment. So we do an enhanced roll investment. Now there's multi-layers of how that has evolved as well. So we've gone from being in front month single contract to being in a static deferred contract, and that's with, for example, in a 3-month deferred investment, to about 10 years ago, Bloomberg created and launched the BCOM Roll Select, which is a deferred dynamic strategy that would allocate to a single contract per commodity and reallocate on a monthly basis, determined by the shape of the forward curve and optimize according to where the roll cost was highest or the drag was lowest. And then we've moved from single contract exposures to multi-tenor. So multi-tenor static, i.e. going into 2, 4, 6 allocations along the forward curve. And more recently, we have long-only investments such as our Bloomberg Enhanced Roll Yield, which is buried, that allocates to the most liquid 4 contracts, i.e. including diversification across the forward curve. And in addition to capturing the curve from those 4 contracts, our berry strategy, which is a very close proxy and tracks very closely the BCOM, in addition tilts the weights to the commodities based on the shape of the forward curve, i.e. will allocate an overweight position to those commodities that are sitting in backwardation and underweights those that are in contango. And in doing so, Berry is able to capture what is an additional a source of return, which is a carry return or a backwardation return. So that has been, in a nutshell, how index products have really evolved as we've seen markets move into different term structures, but also as we see opportunities to capture spot, curve, and carry components of return.
What are you hearing from ETF clients on the types of products that they're seeking in this space right now? I mean, is there an overall trend that
Mm,
you
mm.
that you're seeing, and kind of give us a little bit of an indication of where things are heading?
Yeah, so in the ETF space, it's the commodity universe can really be split out from a Bloomberg perspective into four subfamilies. And across those four subfamilies, we have the benchmark, which is our broad-based long-only investment, which is more of a strategic asset allocation positioning of how commodities fit in your portfolio. And and then alongside that, we can go into the role enhanced. So the strategies I just described, including our Bloomberg enhanced roll yield strategy, would work well there. The second category would be more tactical, and that would be thinking about sectors and single commodities. So, for example, when we have the geopolitical events bubbling up at the start of this year, and we see gold prices moving higher and higher, edging above to $2,000, we've generally seen inflows into single commodities and the more tactical plays coming into effect as well. Then the third pillars for ETF users are thematics. So in the same vein that we have a lot of equity, long, short type thematic ideas and baskets in play, commodities have been used for plays in the carbon transition. So thinking about electrification metals, that's been an ongoing topic for a lot of ETF providers coming into this year. And so alongside that, we have launched recently our Bloomberg lithium and cobalt indices, and they are building blocks that can be used in baskets that would want to capture the thematic play on electrification metals. And then finally, there's been a lot of debate and discussion of how you combine and marry up commodities with the headline challenge of ESG. Now, ESG is very regional specific, but we have seen that coming up as a conversation with end users and clients thinking about ETFs as a way of accessing that. So we at Bloomberg have our BCom carbon tilted index as well, and that's a way of effectively combining sustainability in a long only commodity investment.
Fantastic. Well, we covered a lot of ground. Jigna, it's been an absolute pleasure. Thanks so much for your time. Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.